Hey guys, Freaky Finance here. We got another fun week. We're starting off with Shopify. Quite a few this week. I have Spotify tonight. Hive will be interesting tomorrow morning. We got Disney and JD and AST. There's quite a few names again this week to go through. Baba. Bunch of fun ones. But anyway, today's video is just going to be about Shopify and Vermillion Energy. I'm still catching up on a few names. That's the thing about earnings season in so many positions. So for disclosure here, I do own it. I do own Shopify in 2 accounts, so 15,000 US, and then Vermilion Energy about 21,000 Canadian. So again, fairly sized, fairly confident in the names and the holdings, and they're both. I mean, Shopify's up 26% today. Just a crazy number when you think about it. The last 3 months for Shopify has been kind of crazy. But we'll talk a little bit about, we didn't do a video, I don't think, on either of these, but I'm going to do a little bit back talk about them just as quick as I can. So obviously the market likes the results. 20% growth, 26% accelerated on the top line. Operating income, more importantly, has doubled, and expansion on free cash flow. So what Shopify does, well, so it started off like basically smaller businesses, basically get your website up and running, get you selling right away. It's really good at that. And then they kept expanding. So basically land and expand. So they got your business, they can help you get sales, and then they'll ride on the sales. So they do a POS thing. They get a take of what goes through the platform. And then they also started doing other things like helping you ship their product, helping you track your sales, helping you do your accounting, helping you do your taxes, helping you, say if you need capital, they'll start actually giving you capital and start funding your business. So they started adding on a lot of things, and all these things were margin accretive. So basically, again, land and expand. And they've also moved up the channel to larger companies because the product keeps getting better. There's also a subscription model, which the market really likes. Basically, anytime you have recurring revenue that's expected or high probability, the market treats it as a better quality of revenue. So I think that's also happening with Spotify or Shopify over time. I'm going to constantly say it's Spotify because I owned actually Spotify for longer than Shopify. Anyway. You can see there are 4 different tiers here. Obviously, Plus is the most features, and they charge the most money. Balance sheet, like the other tech companies we talked about, is relatively immaculate. You just see cash, marketable securities, and they have long-term investments with the firm. So really not a lot to talk about. And on the debt side, you just have convertible notes, 900 million. So again, really strong balance sheet. It's finally, you can see the paid-in equity is quite high. They finally started to get out of the accumulated deficit they've been in, and now they're going to be in actual retained earnings for probably the first time in the company's history at the end of this year, as they are right now. So that's exciting because it means it's made the transition from a growth to profit, which wasn't the case, say, 5 years ago. And you can see the cash flow starting to show up. And, I mean, you can see they're not actually doing much, which I'm okay with. They're not, like you can see the capex. They don't have to invest much in the business. They were for a bit. We'll talk about that in a little bit. But they've basically killed the capex, and basically they're just investing in marketable securities with their cash and letting it slowly build. Anyway, not a lot to say about the balance sheet. It's still in a growth mode. It's not like we're getting dividends or buybacks here. And to be fair to the company, it's not exactly like Shopify is cheap. It's probably one of my more expensive positions. The thing to note about Shopify as well, the gross margin is pretty high. You can see the subscription model is amazing, right? 82% margin, reoccurring, steady expected, right? It's just nice. Whereas the gross merchant side is lower margin. So it'll be interesting to see as they keep trying to get more and more sub count how that works out over time. But you can see right now Merchant Solutions is still a dominant part of the business. But what I like to point out here is you can see the scale, right? When you get 124 million more revenue year over year in subscription, but only have to spend an extra 20 million to get it. So that's nice margins, right? Now, one of the cool things with Shopify, and one of the reasons why we bought it, is because they did a big headcount reduction, and they also switched from being a fulfillment center. They weren't sure they were going to do the logistics themselves, and they decided not to. And that made the decision to buy this company a lot easier. So anyway, you're seeing the cost savings here in the G&A line. You're actually down year over year, and you've seen very little increase relative to the revenue growth. So you've seen scale in 2024 versus 2023, especially this quarter. again, this is just a letter that the CEO Toby sent out, and basically this is when they're making the hard decision to cut 20% of people. I mean, we saw a lot of this in tech where they overhired in 21 and 22, and then they all had to let go of people, and then the stock market started liking them in 23. Shopify, maybe partially because Canadian didn't respond the same way as the American companies did when they started cutting costs, because we already started seeing scale before this, right? Anyway, and then we also saw them pivot. So Flexport bought Shopify Logistics, so they didn't have to worry about it anymore, and that's why you see things like the capex being $2 million in a quarter, right? From used to be 37 on the 9 months a year ago. And it was higher than that the year before that. They were guiding higher before they sold it. So it was a smart decision in my mind to keep it capex light, keep the business model simple, keep it fintech orientated, and keep it software orientated, because this company is basically growing on the back of software. They're not a logistics company. So it was confusing to the market, right? Because they tried to compare it to Amazon if they kept going logistics route. Another thing, when you do a lot of headcount reduction and you see limited share price appreciation, we've seen it now, but for a while there, it's been pretty much flat, right? Here's 2021, right? You can see it is down, and then basically, it's recovered a bit, but it hasn't really shot back up till now. But the business has improved since they did the layoffs in May, even though the thing was flat for more than a whole year. Jumping ahead of myself here. But you can see share-based comp is down, which is nice, specifically in R&D and honestly across the board, which is nice, especially relative to a growth rate that's over 20% year over year, right? So you just saw scale across the line, and markets always love it when they see it. And usually that's my cue to be like, okay, trim some, but we'll see. Shopify's never really traded on a multiple that's anything reasonable to make a decision like that. It's more of just a style factor of growth in Canada, which is sorely lacking. Here you can see scale on sales and marketing going from 17% of sales to 15% of sales. Again, just showing you revenue growth with cost control. Here again, R&D revenue growth with cost control, 18% of revenue to 15% of revenue. The G&A, 8% of revenue to 5% of revenue. So scale in every line. I love to see that. This is just an example of them still expanding, like they're going more international. And again, they're doing the Shopify, so the POS, point of sales, and picking up more of the transaction margin that way and riding on the sales of their businesses. And they're doing good links. Like, I don't have time to talk about everything, but they have a good YouTube partnership and a bunch of other things. There's a couple crazy examples where they've just been able to help companies that get stuck and just put them right on a platform with all the SKUs that they offer, like, overnight. So there's something special that Shopify has, and I think it's worth bringing up. I'm going to do a deep dive at some point and maybe try to color some key parts of what I like about it. But here you can just see, at the end of the day, the margins are expanding while the growth rate is actually accelerating. So you have G accelerating while margins are expanding, while you're seeing scale and everything and cost control. The only thing we don't have is share buybacks or dividends, anything to reward a shareholder, aside from the capital appreciation, which we just saw. And yeah, I guess we are up 87% there, 42% there. So, because I don't think I've been in that company for more than a year. Or maybe it was around May. I remember looking at them when they did the layoff letter because I thought it was well written by Toby. And it's a hard thing to do as a tech guy. Anyway, here is Vermillion Energy. It's another company I own in Canada. It's not, I would say it's up there in terms of exciting, but again, as a commodity, you're a price taker. So we did a video at Suncor that talked about this quite a bit, where we made some good returns on that. There's a couple other oil plays we've made that were pretty good. This one is basically, it's trading like a Canadian oil and gas company, but 41% of its FFO is European gas. And European gas has actually gone up in 2024 now, but the share price has just gone down with the rest of the Canadian market. And so what's happening is the company's still getting all this cash because, the free cash flow there. So what they're doing with the cash is, what they've done for the last 3 years is basically pay down debt, because this company got destroyed during when oil went to zero. They had a huge dividend. People relied on it, trusted it, and they took it away. And then the shareholders basically left it for dead. And we've rode this once up before. And so I'm trying to, obviously I have a position and I'm trying to get back into it. And what I like is when I see the TTF prices start climbing and Vermilion still going down and not responding, and we're seeing the buybacks and we've seen the deleverage. It's exciting for me. Obviously, the share price is still going to react to what it's currently reacting to, which is the commodity market, which you never really know what's going to happen. So short run, anything can happen. Long run, it's exciting to me based on current information. And here's what I mean with it. So TTF's the red line shooting up. WTI's oil is corrected, and AECO's been dead for this whole year. Alberta nat gas prices just destroyed. So what they've done over the last 4 years is really just pay down a massive amount of debt. Right, they've got it from $2 billion to $800 million or something now. So they've 1.2 billion in debt just gone, which is nice, right? You've seen the debt to trailing FFO go from 4. I mean, this was fake low, right? Because that was when oil was very bad. But you could say like maybe it went from 2 to 0.8. I think it's even lower right now, or like 0.6. And that's with AECO being very weak. Like North American prices are still really weak, right? It's just TTF is held up so strong, even with the recovery back down after the Russian invasion of Ukraine. So we're just seeing this price dislocation, and Vermilion's just profiting from it. And here's just another way to show the prices for JKM. Eurograss is permanently higher, and AECO's just got destroyed. And you can see what they've hedged out for with the average floors, right? So 17% or 17 for the Eurogas at 51% hedge for 25. So it's not like, at least part of the risk is hedged for 25, so we can get even more buybacks hopefully. Because they're starting to show up, and that's one of the things that just happened, is that they finally hit enough of a debt buyout that they don't need to keep focusing on paying down debt because it's already so low, right? They're under less than 1 times. So now they can start paying back shareholders more, and the dividend yield is actually decent here too. And I do like we're not gonna. I don't think I've done a video on the Montney, but I like this region. Like obviously, I'm long term line. I have been for a long time, and Vermilion. Those are like they're right here, right there side by side. So I love this area. Maybe I should go through this area at some point just to kind of show like what I like. But this region right here, I think is special, and the drilling cost has only gotten better. Anyway, we don't go to that. Here you can see the debt to trailing FFO 0.6 times now, so the lowest in 15 years, and that's trailing FFO with an AECO that's very poor, right? And oil's not like amazing; it's not like it's over 100. It's at 70, which is probably average, especially if you adjust for inflation. So it's just, in my mind, it's really cheap, and it could be because they're not sure about the recovery, like how long these assets are going to last. Like, is this company has a 10-year life? Does it have a 5-year life? Does it have an 8-year life? Right? Maybe that's why. But it's just interesting to see how it's reacting so much to Canadian prices when it's 41% of its cash flow is European, and then 15% is Brent in Australia. So it's just totally different. Here's just me just showing the debt going down from 1.2 billion to 800 million over the last year. I mean, like I said, it went from 2 billion down to 800. So pretty strong. And here's them paying down debt in the red, and then you can see the buybacks starting to creep up in 24, right? And that's year to date. You can already see it shooting up, and that's what I think is likely to keep happening. So we're going to see more and more buybacks, which is exciting for me because the leverage has already happened. So the bondholders, the balance sheet's got so much stronger, but the share price hasn't reacted to it. So one of the cool things, so like say during 2020, you can see they're all kind of, so this is, I should have explained, this is Vermilion, the blue, with XEG, which is like the Canadian ETF for a bunch of oil and gas companies, and then Tourmaline, which is the green. And we knew nat gas, I mean, Tourmaline is probably outstanding relative to what it's done with its hedging programs and its location and its break evens, but you can see just how even just XEG, the average company, is up 50%. If any timeline, it's going to be above Vermilion, right? Up 242%. If I just go from the recovery of the invasion of Ukraine, but you can see Vermilion down 71% since 2012, right? Whereas XEG is just even for 2012. In 2012, I'm picking that because that's when oil prices were very high. But anyway, that's just how I'm thinking about relative value, and I've seen things like the Suncor and Advantage is all held in there, But Vermillion's just been giving it up, even though we've seen TTF improve this entire year. We've seen the share price just stick around here. And here's just me showing the TTF slowly creeping up in 24, really since February, but we haven't seen any response in the share price. And then here is exciting, right? Because it's like, okay, well, what's the big deal? Well, the thing is, if it stays this cheap and they still get the cash flow, which they are, you can see that they're buying back basically, well, with the dividend, 10% of their market cap in 2024, right? And that doesn't include the deleverage that they already did on the balance sheet for the first part of it. So anyway, it's just a unique thing that I really like. Obviously, maybe the market's worried about production, right? Because we're seeing the shut-ins on the AECO side. And that happens when prices get low, right? That's the price signal, right? And that's usually when I start looking at Canadian oil companies and oil gas companies, but usually it's like the quarter after. But we'll see. Usually, we'll see. But anyway, it's just an interesting company. I'd like to know your thoughts on it. I should probably do a video on the different hubs and how they're related, but this one's always interesting because it has such a nice foothold in Europe, and it trades like almost in lockstep, if not worse than the Canadian peers, even though the prices in Europe have stayed stronger for the producer. So anyway, I'd like to know your thoughts on Shopify and Vermilion Energy, and have a great rest of your day.